AZ. How is everyone doing? Welcome to Webinar Wednesday, another beautiful webinar that we have set up for all of you today. And today specifically, we're going to be talking about real estate marketing trends. So for those of you guys that are new to my webinars, just know that the chat is enabled, so feel free in asking me any questions. Right on the side here, you can type in your questions and let me know if you have any questions on what I'm talking about today. You can also text me. I do have my phone next to me just in case it is easier for you. So let's go ahead and get started, guys, because today we're going to be talking about real estate marketing trends. And we had the great honor of having our wonderful Tina Tambor with the Cromford Report at our office in November as we were preparing to actually put together our business plans. And just for any of you guys that don't know, the Cromford Report is a report that is put together by Michael Orr. Tina Tambor is a consultant there. And so a senior real estate analyst is what her name is. And the Cromford Report provides analytical data, market trends, sales, actives, spendings, anything that really happens in the MLS. They pull numbers from there and then prepare great reports for all of you to actually be able to not only educate your clients, but give them a more wise information and decisions that, to help them make decisions and information that they cannot necessarily find on the internet. And then also what I love the Cromford Report for is because it helps me create a really good marketing strategy. Because if you know where the market is going or where the market has been, because the real estate market is cyclical, then you're able to really build strategic marketing and prospecting plans that correlate with what's happening in the market. So it's super important as you're building your business plan to know exactly what's happening. It's also important when you're listing a home or when your buyer is asking you questions about buying that house, whether they should wait or whether they should buy now. So really important data that is derived and pulled from the MLS. So you're able to speak more eloquently to your clients. And today specifically, I'm going to be talking about market reports and the market in general. I emailed all of you 3 different PowerPoints from the Cromford Report that you can use for your efforts. There are 3 different attachments that I sent to you. If you don't have them, reach out to me and I can send them again. The first one talks about the actual businesses and the business growth and what's happening here in Arizona. And from what Tina tells us, it is a very healthy it's going to be a very, very healthy year. Arizona is booming as far as business growth and technology companies coming in, as well as medical companies, especially in the North Peoria area, Glendale, but the corridor off of I-17. And a lot of great data on here on websites you can actually look at to try to establish what's happening as far as growth goes in each of the cities. So I'm not going to go over that PowerPoint today, but you do have it. You have it for you to use and to insert in your own particular listing presentations. So take a look at that because it's going to make you feel very confident and happy about 2017. Today, and then the second PowerPoint talks about fix and flip properties, which is great for your investors. Talks about just the different types of flips sold, where they're buying and selling. Specifically, I love this map, flips that lost money versus flips that made money. This is incredible information for your clients to make valuable decisions, decisions that actually make sense. It goes into really direct numbers on the west side. So you definitely want to take a look at this Cromford Report or this PowerPoint because it is powerful. So it even goes into profit and all of the different metropolitan areas where there is opportunity. And it is expected for 2017 to fix and flips actually to go up. And there is this wonderful little list here of all the cities in Goodyear and exactly what's happening within that spectrum. So you want to check that out yourself as well. Today specifically, like I said, we're going to be focusing on the real estate market and how to explain to your clients what is happening and what's going on out there. I definitely don't do as good of a job as Tina because she is a senior real estate analyst for a reason. But I can definitely get through them and show you exactly what has happened and what to expect for 2017. So let's go ahead and get started. So I'm just going to go really back quick to make sure I don't have any questions or anything like that. I do see that my attendees have joined. Thank you guys for joining. The chat is enabled right here on the side, so you can type hello. Sorry about the confusion with the links. For some reason, if you do not begin right at 5:30, the link disappears completely and you're in trouble. And I hit it right at 5:31, and I think that's why it disappeared. But we are back in action, so feel free to ask me any questions here on the side. I was just talking about the Cromford report and just talking about the different PowerPoints that I've emailed all of you to use specifically for your marketing strategies. So today specifically, we're not going to look at the fix and flips. We're not going to look at what's happening in Arizona as far as businesses, but we are going to look at, again, what's happening in the real estate market, specifically in the West Valley. So let's go ahead and get started. The Cromford Market Index. The Cromford Market Index, it really relates to the volatility of the market, and it really, anything under 100, which you'll see right here, 125, 130, 135, anything under 100 signifies a buyer's market. And as you can see, from May 2016 all the way to November 2016, we've really been in a seller's market. However, as you can see, as it was going up, it also is going down. We're at 145 now, still a seller's market. However, prices are adjusting, buyer demand and inventory is adjusting, which is causing the index to go down a little bit even more. So this is a general number for the entire Maricopa County. So would you say this to somebody in a $500,000 price point that it's or a $600,000 price point that it's a seller's market? Probably not, because as I get into the charts here with the additional charts, you'll see that price points, areas, neighborhoods all have different types of markets. But in general, right now, it is considered to be a seller's market, and it does look like it's winding down. And that has to do again with the influx of inventory and demand still staying strong. I mean, it hasn't weakened too much, but demand and supply are really staying one-on-one. Cromford Market Index in the Southeast Valley cities. We're not going to look at that chart because we're not in the Southeast Valley. I don't know where she included that one. I think she made a mistake there. So new listings year to date by price range. This gives you a really good idea about inventory, right? And as you can see in the west side, under 150,000, we have 2015 is this blue right up here. So we were at 10,846. With 2016, we are at about 6,819, which means there's a negative 32% from what it was in 2015, which under 150,000, that makes sense, right? It's a lot harder to find a home for someone under 150. 10,000 versus 6,000, a lot of people got sold out of the, a lot of people got bought out of the industry, because if they qualify for 150 back in 2015, they had a lot more availability. But now we are negative 32%, which means there's only 6,000 homes that they can actually choose from. It does look like it's starting to go up a little bit and a little bit more right here, but it's not something too dramatic where it goes down by the weeks down here, and then this is the actual number of listings as it is increasing. It looks like it is increasing again, and that may have to do with fix and flips. That may have to do with price reductions, which I'm going to get to that slide in a few seconds, because we are adjusting. In January is the biggest month for price reduction, so we're going to have a huge adjustment in general of the market. And something very unique is happening right now, which is that even properties at 200,000, 180,000 are still getting price reductions, when typically that doesn't happen. You know, it's always the properties, you know, up in the 280s and 290s, or 300s and 500s and 600s. For 150 to 200,000, here's what it looks like. For 2015 is the blue here. We were at 11,085. And for 2016, we're at 10,947. So we're about 9% up. And that's just because it's not calculated through the last week yet. But that gives us a really good idea as to why even people at 150 to 200,000 need to be strategically priced correctly. Because if in 2015 we had that same situation and it's creeping up in the same way, that means buyer demand is staying the same. So that means buyers don't have necessarily like the same leisure to actually just hang around and try to, you know, see if something else comes on the market. It's really staying hand in hand. So as long as buyer demands continues to stay strong, which it will start to increase in January and in February, then we should still continue to see a seller's market in this particular price point. New listings year to date by price range. So 200 to 300,000, a big difference. In 2015, we had 10,784 versus now in 2016, and this is not even week 52. This is only calculated through the end of November. We have 12,705. So what does this mean to you guys? It really means that in the 2 to 300,000, you don't necessarily want to say you're in a seller's market. Inventory is 2% or even out 30% they're projecting for the year, higher than it was last year. Plus, you also have new build competition. And so when you're really talking to a seller that's between the 2s and 300,000, you want to show them the slide and let them know, hey, we are not in an up market. If this number right here for 2016 was a lot lower, then you can strategically price the home so that it is in a up market, meaning even if there wasn't a comp that showed that it closed at a very high value, you could still try to get away with, you know, pricing it at the highest point available, even if it wasn't in the best condition, because inventory was so low. But because inventory in this price point is not, it's staying pretty much the same as last year. And remember, this year we had a lot more new builds. Then you have to really be strategic when you're pricing homes in this price point, because otherwise they're going to sit on the market forever and ever and ever. So I wouldn't say necessarily that it's a buyer or seller's market there. I would say it's a pretty balanced market with the need for us to really price them correctly. On the 3 to 500,000, there's a 17% increase. Same thing. We are at 6,367 homes versus 5,982 homes last year at the same time. So what does that mean? Again, pricing strategically is important because buyers have a lot to choose from. Even if buyer demand stays strong, we got another 1,000 listings that we got to deal with. And so when you go to those listing presentations, this is what you need to be telling them. And 500 to a million, we got a 15% increase projected, with the total of 1,387 new listings right now and 1,384 new listings in 2015 around this time. So 500 to a million, it's keeping pretty close, very close to last year's numbers. And so again, there's a lot of inventory that's still out there. So you want to be able to show them what these charts are doing. And over a million, we're actually at -2, which means we've been selling some of these properties. Now, even though some of the ones that look like it's a buyer's market, then that's a great message for you to get out and talk to your buyers and say, this is the time, guys. You have a lot to choose from. Inventory is up. We can get you a good deal. Don't wait for it to turn into a complete seller's market to get your buyers to come off the fence. On the seller side, you just got to teach them how to be strategic with their pricing and be creative, right? What are they offering? Are we going to offer an incentive to the agent who brings us a buyer? Are we going to offer, you know, closing cost assistance? Are we going to offer some type of, I don't know, personal property that goes with the property, especially in the $1 million? You got to be super creative. The house has to show very well. But being that it went from 101 to about it looks like 118. We're staying pretty steady with these. There is going to be more demand for the $1 million properties and the higher end properties up in the Peoria, Glendale area. And that has to do with this PowerPoint that talks about all the different things and businesses that are coming into the industry. Into our areas, which will then create a demand for the more of the higher end property. So you got to check out that slide as well. Okay, new listings year to date. Northwest target area, all price ranges. So let me just go back really quick to make sure no one has a question. Does anybody have a question with what I've said? Sandy and Greg, hello. Any questions at all? Okay, let's keep going then. So this is new listings year to date by price range. So we have here, Greater Phoenix is Northwest target area, all price ranges. We have an increase of 4%. So what we got to look at is what buyer demand is doing, because the listings are increasing, I'm sorry, compared to the actual what's happening with the demand. So we went from 2575 to 3034 back in 2015, and this is all price ranges. So we're keeping steady. What we got to really again pay attention to is this buyer demand and see what it does in the next few months. Here's our total supply for Valley-wide. We're actually negative 0.8. So West Valley, I think is I think it's actually for the West Valley. We're going to be seeing, in general, we're going to be seeing a little bit more of increase. And as you can see, for the West side, it's 6% increase in active listings versus in general for Maricopa County, we're actually at a negative 0.8%. And this number gets driven down a lot because there are some areas that it's a complete seller's market, like you can't find anything, and all those numbers are combined together. But in general, for the West Valley, and this does include Goodyear, El Mirage, Buckeye, Peoria, Glendale, pretty much all of those areas, we're at about a 6% increase of listings. I think one of the major factors as to why this is happening, again, it has to do with the competition we have in the new build community. And, you know, in places like Phoenix and places like Scottsdale, there's just simply not enough space anymore to build new homes. And many of the communities that are being built, like in Phoenix and Scottsdale, which you'll see in the business report, are actually like apartment style. They're not actually single family detached. And so they don't have the same increase of inventory. Our inventory has been driven up based on the fact that we do also have, 18,000 new build permits that went out just this year. And so both of them are actually getting, they're getting competition. The resale market is getting competition from the residential market. So that's what I truly believe the 6% increase is. It's not a lot, it's super tiny. And as long as the number of transactions we close every single month continues to stay up, then I think we're gonna be okay. Total supply for the Northwest target area, and we are talking about, this one is just Glendale, El Mirage, Peoria, that kind of thing. And here it is, and the blue is again the 2015. As you can start seeing, numbers started creeping down to about 1436 on week 52. At the end of November, we were at negative 2% of total supply. And what does that mean? That means that in general, the buyer demand has been very, very healthy in this area. We're keeping up. It feels like it's a flat market because inventory comes in and then also the buyers, they come in the same amount almost. But it has to do with the fact that there's there's everything. There's a new build community, there's the resale. And so now at least the negative 2%, that's why we call it a seller's market. That's why the Comfort Index report shows that. Because in general, the supply has decreased compared to where it was last year. Okay, new listings by month. We are actually in a normal market with this. So let's look at 2013, 2014, 2015, and 2016. Now, these arrows right here, the reason she's pointing them out is because look at this month right here. It's really, really hard to actually see the numbers in the back, I know, guys. But this right here, May, June, July, August. October. Very cyclical. So if you look at these charts, they're all going to pretty much tell you the same thing. How many new listings we get each and every month. As you can see, December is always low in every year. See that? And then do you see how there's a huge increase and always in October? And that, as you can see, from 2013, 2014, 2015, and 2016, it stayed pretty much about the same. And so what does that mean? January is actually the month with the biggest price reductions. We start to increase inventory right around October. Inventory doesn't increase in November and December, see that, as much, except for 2016. 2016 actually, very, very different. It went from low, low, all the way highest here. Well, actually, that's October still, and this is November right here. So it went down a lot. Again, inventory, biggest month to put your house on the market is going to be October. But then again, remember with November and December, the activity for buyers kind of slows down a little bit, which is why inventory doesn't go up as much. And then come January, you actually have a ton of price reductions. So this is a great chart to when you're looking for someone who is actually wanting to be more strategic about listing their home. Is it ever a bad time to list a home? No. If you're strategic with your price, it's never a bad time. So you should be okay. Weekly price reductions. Now this chart really surprised me because typically we do not see such a huge amount of price reductions on listings under 200,000. We haven't really seen that in a while. So what that's meaning is that there are a lot of properties out there under 200,000 that are overpriced. There's a lot of optimistic agents and optimistic sellers who really were looking towards an up market that will continue to go up tremendously. But the numbers that are forecasted, which are in the other two PowerPoints as well, you know, the appreciation should only be about 4 to maybe 8% total for all of 2017. So we're not increasing like 20% or 10% even, or even 30% like we were back from 2008, where we're at now. And you need to have these conversations with your clients because a lot of the people that are listing these homes right now, they bought them in 2008 in the downhill, and they bought them in 2009 for, you know, especially on the West Valley, 120, 140. And now, you know, they still want to get 280 for it. That's like more than a 50% increase. They're not losing money. They made great money because they made a good investment. It's just that the market is not allowing for them to appreciate at that amount anymore. We hit rock bottom, appreciation started to climb, and now we're at a point in the market where it's balanced, it's stable, it's what it would have looked like if the economy had never had that meltdown. If we had skipped those 4 or 5 years of that mess that we went through, we are in the same place we would have been before all the madness started. And so it's very unique right now that we are having price reductions on listings under 200,000. And most agents are not aware of that. They just think, well, under 200,000, I should sell this baby in 2 days. Again, there's things to choose from. There's inventory out there. This is not the conversation you want to be having with your client. There's huge price reductions coming in under 200,000. And the biggest month for price reductions, again, is always January. Demand for homes, because in the end, we track supply and demand here, right? Year-to-date sales. So again, the way we figure out if the demand is strong is to keep track of how many sales actually happen, right, every year. So here we are, 2016 at 6,240, where in 2015 we were at, let's see, probably a lot higher, which is 10,881 by week 53. So by the end of 2016, we need to be at least 10,281, under 150,000, to kind of really meet what was happening in 2015. But again, the reason this number is negative 33 is not because the demand has weakened. It's because there's just no inventory under 150. We would have a ton more sales under 150 if the inventory was there. It doesn't mean that buyer demand has weakened at all. It just means that we just don't have the inventory to actually make it happen. West Side, 150 to 200,000, a bit of a different story, right? 2016, 9,392. And right now, November already, 9,462 with a 16% increase, meaning by the end of 2016, price points between 150 to 200,000 are going to probably surpass, they will surpass 2015's numbers. So what does that mean to me? that even if there's a lot more inventory, including the new build community, because these numbers do not include the new build community, that its demand is still staying steady enough for it to continue to absorb the new inventory that does come into the market. But again, not to a point where you can price homes that are not market. You got to be strategic with these price points and make sure that you're listing them at something that actually has closed, or if it better be like a spotless, beautiful, property for it to sell at the highest point possible. West Side, 200 to 300,000. We have about a 31% increase in that. We were at 8138. We finished off the year for 2015 on 8138. And then we were in November, end of November, at 8262. That's a 31% increase in the West Side at this price point. So again, I would not go telling my sellers that it's a buyer's or seller's market in this price point. I need to really look at a comparative market analysis within that neighborhood to see what my real competition is going to be. And then year to date sales on the, sorry guys, just to make sure. It should probably, this is a good sign for us though, because if it's only 9262 here, I mean, that's higher than already 2015 altogether. That means that we're going to end the year a lot higher at the 200 to 300,000, which again means that the demand is there. The demand is there if you're strategically priced, right? There's going to be an increase there. Same thing with the West Side on the 300 to 500,000. We had a 22% increase of actual sales and closings, which is pretty awesome, because again, that means if this number was negative or if this number was lower and inventory was also up, then I would be really worried. But the truth is that this number is up year-to-date sales, and so is inventory, which means demand and supply are actually coinciding with each other. They're actually working out very well for us. For sellers, it may mean that their appreciation on their home is not going to be huge next year, maybe 4 to 8%, like I said. But for you as a real estate professional, this is really good news, because you're going to have the best year ever. Because what this means is that we're going to have more volume transactions. You're going to have more of the ability to tap in and take a piece of that pie, because there's more movement, there's more turn within the actual real estate market. And in the 500 to 1 million closings, we're also up 23%, which is pretty exciting. 525 versus 562 in late November. So this is really good. We had way too much inventory in 2015 in this price point, and now we're getting rid of it. Summer was actually pretty busy, guys, believe it or not. And winter hasn't slowed down. It's just that the amount of properties that come on the market, as far as the ones that close, is pretty steady. They're staying one and one with each other. Then over a million, we're at negative 26% as far as sales. And that's very, very common in the luxury segment. In 2015, we were at 27 sales over a million in the West Side. And right now we are at 17. It's projected to go down a little, about 26%. So you definitely want to be talking to the sellers about a buyer's market in over $1 million price point. And in the West Valley, they're just harder to find as well. Over a million, Litchfield Park, North Peoria, they're going to be more and more prevalent next year. But this year in itself, it's just trying to get rid of old inventory. And then Northwest target area, all price ranges, we're actually up 4% on sales, which is really good, guys. That means demand is definitely keeping up to pace. We are at 63.77 for 2015. 2016 in November, we were already at 58.74, which should give us, close to 5-10% increase on sales. And that again is why inventory and demand is keeping right on target with each other. Under contract, so pendings, valley-wide, we have an increase of about 2%, which is great. Again, and that's where, those whole numbers are correlated with the wholesalers market. But a 2% increase is good, because that means we're actually getting things under escrow. In the West Valley, we're pretty flat compared to last year. We're flat as far as inventory coming in, demand going in, and things going under contract. So that means pricing is probably staying pretty close, and so is buyer demand and inventory. Under contract in the Northwest Target area, we are up 4%. And I think that has to do with just all the buzz, everything that's happening up in the Northwest area. There's so much growth economically with businesses, with homes, with everything that's happening. I should expect for that to continue to increase even more. We were already at 794 in November, and we were only at 615 by the end of 2015. And you got to remember in 2015, things were much more affordable. So this is really good for our market. Pricing trends, because this is going to be important when you get to actually do a CMA and price some listings. Oh, this is so good. Average sales price per square foot. Now, this is definitely not the only way to come up with the pricing on your listing, but this helps you because if you have a really hard property to comp, to pull comparables for, then this helps you at least to try to figure out what appreciation is doing. So let's look at what it's done here. This is February 2000, and look at the peak right here. Isn't this fabulous? This beautiful peak. What month was that? May 2006. Oh yes, May 2006. We were at Valley-wide. This is Greater Phoenix, close to almost $190 dollars per square foot. Then things started to get really, really bad, really quick. And then May 2009, we hit a rock bottom of almost $80 per square foot. That is crazy, right? And then we started slowly going up, slowly going up, slowly going up. And then August of 2016, we were at $144.66 per square foot. Now this is Greater Phoenix area, so please do not go use this number for your listing in Sun City or in Peoria. It's Greater Phoenix, and you can calculate this stuff even within your area through the MLS. What it's showing here is that there's going to be about a 2 to 3% annual appreciation. This is what I keep telling you guys. It's not going to be huge. It's just going to be pretty much normal. And I love what Tina said is that, you know, we wouldn't have gone through this whole economic meltdown. We really are in pace as to where we would have been. So let's pretend that these years right here, all of this never happened. Let's delete from our memory 2006 all the way to here, 2011. And as you can see, we are growing very healthily. From 2000, if we forgot all these years and we went all the way to 2016, that's exactly what a real estate market should be doing. So this is normal. This is what should be happening. We shouldn't be gaining equity of $80,000 a month or $50,000 a month. And I think that's the thing that you as an agent need to really educate your client on, especially if they bought in 2008 right here. These are the properties that are being listed right now in 2009. You know, they bought them at $80 a square foot, and now they still think they can get it at 190. That's not going to happen anymore. That's just not, because our market is not appreciating. When you get properties at rock bottom, of course, right, they're going to start appreciating. But look at this. It's not that much. It's not huge. It's about from 80 to 130. So we're talking about $70 per square foot. That's huge, right? If you did buy at that price point. But if you didn't, and if you're this guy over here in 2013, and you talk to your neighbor, the one he bought in 2009, how's he selling? It's not going to be the same story. So it's very, it depends on when they bought, and it depends also on how much money they put down, of course, how much they own the property. But very healthy, 2 to 3% annual appreciation. I'm projecting more for Peoria, more like a 4 to 6%. But you know, this is what the numbers tell. Average sales price per square foot in the West Side specifically. So this was Greater Phoenix. And in the West Side, we were at bottom low in 2000 at 74. We skyrocketed to close to 160 in 2006. We went all the way to the bare bottom in 2009, and we slowly started to climb up. And this is where the 3 to 4% I get it from. And then we are right now at about 118 to about 121 price per square foot. And this is in the West Valley. That's the average right now. And this is all price point, guys. Annual appreciation by price range. Now let's see what this one is doing. So we have here, this right here on the side is the colors representing the cities, and the bottom is the actual years. So let's look at Peoria, and here's Peoria. Here's the blue. So in 2014, appreciation was at about 9%. Started going down low, 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 2014, 2015. Started climbing up again, appreciation. And right now we are at right here, Peoria at about 5.5%, Buckeye 9.6%, Avondale about 9.0%. Why? Because properties are a lot cheaper down there than they are in Peoria. Glendale 6.4%, Surprise 6.4%, Goodyear 6.1%, and Peoria 5.5%. That's what the market did in 2015. Those are also the projections for 2017 that we're not, again, that's why I keep telling you guys 4 to 8% is really where it's going to be at, even for Buckeye and Avondale, because Buckeye and Avondale got rid of a lot of inventory that was under the 150s. Buckeye is booming with so much growth, and it's expected to be the biggest city in Arizona actually in the next 20 years. So things are changing up tremendously, but the people that bought at the core bare bottom, they got in at a really good price and they have this huge appreciation, but they shouldn't be expecting that for next year. It's just not going to happen. Average sales price per square foot in the Northwest Target area, again, went from 80 back in 2000 at our peak, and then right now at about 140 and 74 cents per square foot. And this is in the Northwest area. So you see how different that is from like Buckeye, Goodyear, or any of the other cities. Annual appreciation by price range. Let's look at this. This is great. So over 3 million, they actually had an 8.8 annual appreciation, which is really interesting. There's probably been like 2 to 3 sales only in the Northwest area, right? 2 million to 3 million, negative 1.1, 1.5 to 2, 1.5 negative. Let's look at down here at the bottom. 1.1% for the 100,000s. So it's a range from 1% to max that I see on here is 4.4%. And that's for properties, I'm sorry, for the 150 to 175,000 and then the 125 to 150. Well, of course, because those properties don't exist, and of course they're still appreciating at a very high value, 9.2, 6.8. And as you see, as you start going up on the numbers, this one's kind of like anomaly. I don't know what, there must have been like 1 or 2 sales that totally rigged the whole calculations. Because 8.8% on over 3 million is kind of crazy. But as you see, as you start going up higher in price points, the appreciation also starts getting smaller and smaller, and that's very, very typical. This is a great chart to use when you're in front of a seller who's sitting on the fence and who's saying, oh, you know what, I'm just gonna wait for the summer, or I'm gonna wait for 2018 and see what happens. Well, you can show them this chart and they can see what appreciation really is doing. That in fact, if they wait, for 2017 to see what happens, that they could possibly only be gaining, $5,000 to $10,000 more of equity. It's not a big deal. And that now, because buyer demand is still strong and steady, that it's the time to actually list and get it out and sold. Northwest Target area by price range under 200,000. So it gives you the price points. The price per square footage in the Northwest area. It's a 3-month moving average sales price per square foot. And you can actually start seeing here at the bottom the years and what it's actually doing. And as you can see, we are definitely going up under 200,000. We are at 128 and 62 cents versus last year, which was in November of 2015, we were at only about 116. So in the Northwest area, under 200,000, the price per square footage has gone about $10 to $12 up. So you can start having those conversations as well. In the 2 to 300,000, we went from, we were at $134 price per square foot. And last year around this time, we were at about 128. So again, about $6 increase in price per square foot. In the 3 to 500, we have been going up. I love these little dips from 104 all the way back in 2010 to now 133. So it's not huge, but it's steady, 133, 133, 132, 131, 128. Again, not a huge increase, but it's definitely something good because it's going up, but don't wait around to try to sell it at a higher point because it's just not appreciating that fast. 500 to 800,000, we were at 160 price per square foot compared to 134 back in 2010. And it looks like we are, it went down a little. It's very interesting to see this October of 2016. Don't know what was happening that month exactly because we had a lot of cancellations as well, but it took a huge dip. It may have to do with lending guidelines. It may have to do with a million other things. But the good news is that it is starting to creep back up. But you got to show this to your clients so they can see that just as much as it goes up, it can actually go down. If they would have sold it in this month, they would have gotten a lot more than if they would have waited to do it this month. And then over 800,000, they're actually adjusting. It's not a negative thing, but the fact is that we have way too much inventory compared to demand up in this property and these values. So you want to show them this chart. It went from 149 back in 2012. We're at about 207, still healthy, right? But it went down. It went down from March 2016, and it's continued to dip down. And so that has to do with the fact that the inventory has grown tremendously and the demand has stayed pretty stable. So here's a quick summary of November 2016. Job growth and corporate relocation is positive. It has expanded into downtown Phoenix and south of Sky Harbor Airport. Still strong along I-10, which is awesome. The West Side expansion focuses medical and industrial, especially assisted living. How close are we to Sun City, guys? There's so much opportunity out there to actually make something happen. Flip investors are filling the need for move-in ready entry-level homes, and they do sell very quickly, guys, because everyone wants to see that beautiful model-like type resale home, right? West Side appreciation rates. Oh, and by the way, for the flip stuff, look at this chart because this one is all about flips and investors are coming back. We have a lot more activity in the market for that particular niche. So learn the areas and learn exactly where that's happening. Flip investors are feeling the need for move-in ready. West Side appreciation rates are a combination of supply-demand issues and investor flip activity. And I also believe new build activity. And so that wasn't included here because Cromford does not have access to new build data. The Northwest area is more balanced in supply and demand, stabilizing appreciation. And there's more competition from new construction, especially in Peoria and North Phoenix. She did say that. And then West Side would need to appreciate another 29% to reach the peak of 2006. So if you still have sellers that have bought a house in 2006 for $1 million, and it's only worth 500, they would need to wait. If we're going to be only appreciating 4 to 8% next year, and if that trend continues, they would need to wait almost 3 years to get back to the price points of 2006. So if they're willing to wait that long, it's 3 years, and if not, then this is when they need to actually do it. But 29% more, and then we would be back to the 2006 pricing. That's when the market just completely broke open, and we were increasing in equity of 20, 40%, almost even sometimes per month. It was the scariest thing in the world. So this is a quick summary again, guys. And you have been emailed, like I said, the other two reports, the fix and flips reports, as well as consumer confidence and what is happening in our economy here in Arizona. Overall, what I got from Tina Tambor at the Cromford Report and from many other people that I've spoken to is that 2017 is going to be an incredible year for the real estate market, specifically for realtors, because there's going to be a huge turn of properties. There's going to be volume transactions. There's going to be opportunity for all of you guys to get a piece of that pie. For sellers, it's not going to be a huge appreciation year, but so many sellers are ready to move up. Empty nesters. We have people that are wanting to, go into a new home, and now new home builders are building specs. We have new businesses coming into the industry. Into our area. So it just really does position us for a very, very, very good 2017. And this 2017 is going to be very different, where there's no, easy lending. There's no things that would really tank our market as far as what happened in 2005 and 2006. So the name of the game is that there's no magic pill. It's a grind. It's getting in front of people, getting in front of contacts, using this data, using this information to educate them and to help them make this very, very important decision. So overall, it's going to be super healthy, guys. It's time for us to get out there and build our strategy around these reports so that we're doing things, not just throwing spaghetti on the wall. We're actually doing things that make sense. So do we have any questions, guys? We have a couple of minutes for questions, so I will stop right there. How do we obtain reports for our specific area? Good question, Sandy and Greg. Cromford report is a report that you actually order. It's a subscription. You go to cromfordreport.com, which is cromfordreport.com, and it's a paid subscription, and you can pull all of these reports. Not only these reports, there's a zillion reports in there. Bank owned, on rentals, there's PowerPoints and all that. And then what it is you pay, it's usually, I think, $39.99 a month, but through First American Title, I have a code that you can use, and it will only cost you $19.99 a month. And these are awesome for listing presentations, for buyer presentations. You can pull reports on zip codes, on cities. You can do inventory, buyer demand. I mean, they have about, I'm not kidding you, hundreds of reports in there, and they're easy to use. They also do training for you guys. If you're part of their system, it's definitely worth looking into. I really enjoyed these reports, and I use them also in my sales meetings, which I'll share with all of you guys. But of course, it's much more powerful to get these reports yourself and be able to pull them. Do we have any other questions right now, guys? Anything else? I know it was kind of fast, and believe me, I don't even know how to explain it as well as Tina does. There's just so much data and info in here, but we will be bringing her back to the office. She will be coming in. She will be coming in once a quarter because we need to get updated on this stuff. If we don't know what's happening in the industry, we're kind of just like blind realtors out there trying to figure it out. So I do truly believe this is one of the best tools out there that exists. Do we have any other questions, guys, at all? Awesome, guys. Looks like we're all set then. I will go ahead and replay, or actually post a replay on the Facebook group page. I thank you guys for taking the time to join me tonight. Our next webinar is not going to be next week, but the following week. And so check out the training calendar. There won't be one next week. We'll have a tools and resources and marketing class on the 4th in the Northwest office. But then we get back to our regular webinar Wednesdays on the 2nd week of January. And just look at our training calendar. We have some really good stuff coming up. I'm going to be showing you some really good things to continue to build your systems with buyers, sellers, and tools and things of that nature. And if you don't have these reports, I emailed them all. Please send me a quick message and I will send them to you as well. 3 different PDFs that, again, you can use in your PowerPoints, presentations, listing presentations, etc. Thank you guys so much for joining me tonight. Have a very great rest of your evening. Happy New Year to all of you. Wishing you nothing but the best, and I will talk to you all next year. Talk to you soon. Bye, guys.